things are really not in our control. At some point in March, we had a massive fall because the market was trying to price in very significant economic and earnings damage over the next 1 year or so. And then in April, the market might have got oversold and a lot of the bad news was priced in. And therefore, we had the 25-30% rally. Now we have come to that juncture after the rally where the market's once again taking stock of the situation. And what it sees is something which is not looking very, very rosy at all. Because the earnings picture, if the first few earnings from this season is anything, this quarter is anything to go by, is telling us that earnings will be very, very dismal going forward and the economic performance will be as well. And as that reality sinks in, the market will step back once again. Now, what we need to figure out is whether we go back to panic levels once again, or the market gives back some of the gains made over the month of April and tries to form some kind of a trading range, maybe between, say, 8,000 and 9,000 Nifty. And then waits for earnings to come in, waits for medical news from the Western world to come in to figure out whether we need to go back up to 10,000 levels or we need to go down much further and retest those 7,500 Nifty levels of the month of March. Now, we are in that intermediate phase right now where uncertainty is taking grip once again. So volatility is expected to continue. And I, for one, do not believe that we are in a position just 2 months into this bear market to pronounce that we have made a final bottom for this market. I think often while judging bottoms for the market, people look at various parameters. Some will look at market cap to GDP. It's an important parameter on which the Indian market has corrected quite significantly. Some will look at price to book, and that is an important parameter as well. But I think the central parameter which everybody looks at, even lay people look at, is a P multiple, the price earnings ratio. And on that, on the question to earnings that you've just brought up, let me give you an answer, a thought out answer. This year, which is the year which has gone by, 31st March 2020, we'll probably end with Nifty earnings per share, EPS, of no more than 480 rupees per share. That's my expectation. That would be a mild degrowth from the previous year. But more importantly, in the current year, which is ending March 2021, FY21 as we call it, there I think we will see degrowth in earnings and not earnings growth as a lot of analysts are talking about. Earnings growth expectations have been brought back, but very few people are still talking about an earnings degrowth. My expectation is that we will be lucky to get away with a 5 to 6% kind of earnings degrowth for the current year. So if you start the clock this year at 480 rupees per share for the Nifty, and you say 5-6% degrowth this year, you get back to say about 450 rupees per share for FY21. On that base, if you say that there will be some recovery in FY22, and I don't think it will be more than 50% growth, or FY22 over 21, you will then get back to 520 rupees per share. That's 15% earnings growth built in over FY21. Now, very quickly, let me tell you where the P multiples stand. If the market, what is the dire scenario for the Nifty for most people? That we go back to 6,000 Nifty, 6,200, which is the previous peak of 2008, remember? So at 6,000 Nifty, if you calculate on the basis of these earnings that I just spoke about, on 480 rupees FY21 and 450 rupees FY21 and 520 rupees FY22, we are talking about the market trading at 6,000 Nifty, mind you, at 13 times FY21 and 11.5 times PE FY22, 2 years out. Now, these are usually not bear market bottom PE multiples, 13 and 11.5, 2 years out, 1 year forward and 2 year forward. Usually we go down to much lower PE multiple levels. So I think on an earnings basis, the way it is going to shape out, I think the market has a long way to fall. And even 6,000 on the Nifty is very much on the table. It's not out of the realm of possibility. This is not a prediction that is bound to happen or will happen, but it's certainly something which is in the realm of probability. Well, I don't think the market's fair value right now is close to 10,000 Nifty at all, by any parameter. At 10,000 Nifty, where we were at the end of last week, ballpark 98, 9900, I think the price to book value was something like 2.3 times, and the P multiple on 10,000 at 500 rupees earnings per share 2 years out is at 20p. I don't think, given the kind of earnings picture we're looking at right now, the market deserves to trade at 20p 2 years out or 1.5 years out. So I think at 10,000 Nifty, the market has no valuation support at all and little by way of earnings visibility and support. And if the market trades above 10,000 in the near term, it would be well beyond itself, and it would be a call to lighten up positions and build cash levels for most investors. And I think that is what my general feeling would be, that without trying to make predictions in absolute levels in terms of what the P multiple should be, what the Nifty level should be, because the whole situation and environment is so uncertain. What you can control, or every investor can control, is not COVID, it's not earnings, and it's not certainly what the package which the government comes out with or not. What you can control is your own asset allocation. That is something what most investors should be focused on. And right now, I would suggest that everybody brings down their equity allocation, particularly since the market has given a good opportunity with the bounce back, to no more than 1/3 of your savings portfolio. No more than 33-35% going into this bear market should be in equities. The rest should be in fixed income and gold, maybe 15% gold and 50% should be in fixed income. Try and get 5 to 6% post-tax returns on your portfolio and hold on to your cash, because this is that kind of a time with so much uncertainty that the return matters much less than the preservation of cash. The thing which I am trying to understand is A, how much leeway the government has, even if it were to be aggressive, of offering a fiscal stimulus, and B, more importantly, if you're saying that the stock market is rallying because of hopes of a fiscal stimulus, what is the stock market hoping the fiscal stimulus will be like? I think the shape of any fiscal stimulus, in whatever form it comes or whatever quantum it comes, will be focused on two parts of the economy. One, direct cash transfers or some kind of cash transfers to people at the lowest end of the pyramid, deservedly so. Maybe give them 2,000, 5,000 rupees directly so that they can spend and they can eat. Now, I'm not sure that a stimulus of that kind actually helps the stock market or the listed universe that dramatically. Sure, you could say that there might be some demand impetus to a few consumption stocks, maybe or maybe not. But I think most of that money will go into food and very basic necessities, and therefore it does not pertain to the universe of stocks. B, it will go towards some kind of a salvage act for MSMEs. And typically, the smallest of the MSMEs who are the worst hit today, which is MSMEs which employ maybe between 2 and 10 people. They do not form small caps and mid caps in the stock market listed universe. Again, you could say that they will probably sort of limit the consumption damage a little bit, but I don't think it is the stuff which will create a new bull market. So even if a stimulus comes for very poor people and for MSMEs, I doubt whether it will come for the urban listed universe, the urban consumers, the urban taxpayers, and the capital market taxpayers, which is the stuff which drives the stock market rally. And therefore, I am not in the camp which believes that the stock market needs to go higher because of an expectation of a major fiscal stimulus from the government at all. Since you mentioned Warren Buffett, he's also sitting on cash and tons of cash sitting on his hands. Unlike mutual fund managers and brokers in Bombay who are telling you to buy because you will never see these prices again, the world's most experienced and richest investor is sitting on cash and is not buying. And that's something to keep in mind. But to your question on which sectors, the screen is already telling you over the last few weeks of the shape of things to come. Pharma is outperforming. Chemicals are outperforming. Select consumer stocks with low debt on their balance sheets are outperforming. Financials are underperforming. Capex is underperforming. Capital goods is underperforming. So the market has already told you that this is not the time to buy financials because they will go through a credit down cycle, an asset quality down cycle of their own, and therefore they will underperform in this phase. There's no way out of it. And it is also telling you that whatever hopes of a capex recovery the market might have had, all of that get pushed back indefinitely. Nobody's going to do capex right now. And therefore, anything to do with capital expenditure, infrastructure, etc., capital goods is not the place to be in right now. So I would say instead of thinking sectorally and also trying to figure out what the leaders of the next bull run would be, also because we are just 2 months into this bear market, and it's very premature to start thinking about leaders of the next bull market in my book. Right now, don't think about making money. Think about conserving the money that you have, as I said earlier. And I would say spend a lot of time in constructing a high quality 2025 stock portfolio and no more than that. Don't have a very diversified portfolio. And what would I put into that stock portfolio? I would put 3 chemical stocks because they will do well and they will take business away from China. So chemical exporters will do well. 3. You can put 3 pharmaceutical companies out there. Take 3 of your whatever you want because pharma is outperforming and will probably continue to outperform. That makes 6. Take 3 or 4 good consumer stocks. Maybe take 1 paints company, 1 FMCG company, 1 even consumer durable kind of a company business. Because high quality consumer companies with high return ratios and very negligible debt will continue to do well regardless of high valuations even going forward. That's 10 stocks, chemical, pharma, consumers. Now, you can't take financial weightages down to 0, but limit your exposure to financials. If you have to own, maybe you can own a couple of insurance companies. And if you have to own banks, you do not go beyond the top 2 private sector banks, nothing else. No NBFC, no PSU banks, nothing. So that takes you down to up to 13, 14 stocks. Now, what else do you buy? Maybe buy 1 large cap, absolute blue chip IT company. Defensive in nature, cash in the book, no debt. Buy 1 auto company because autos will come back. I'm not sure they will come back in the next 2-3 quarters, but they will make a comeback. And I would put my money behind a good top quality 2-wheeler company first before buying into 4-wheelers. So maybe the best 2-wheeler company that you can find. That's 1. I'm already got it up to say about 14, 15 stocks, and you can throw in small kinds of other sectors and get to those 20 stock portfolio. Limit yourself to that and limit that stock holding to about a third of your portfolio. Reserve the rest in cash. And then if after 3 or 4 months, and this is important, it appears that some development has happened which changes this fundamental hypothesis, be alert to that a vaccine has come out miraculously or the virus has gone away miraculously. Then you change your hypothesis and you become more aggressive. So be alert to the universe, but be very conservative and be extremely careful about preserving your cash at a time like this. This is a bear market. It will have ups and downs as we saw in April, but I don't think the last word has been said about this bear market, nor do we have a final bottom yet in terms of either price and certainly not in terms of time.